Investments in securities are subject to market risks. Read all related documents carefully before investing. Hello and welcome to the Weekend Investing Daily Byte episode. We are shooting this on 1st of June. So we had a good month of May where while most people were expecting May to be a month of sell in May and go away, but it was buy in May and stay in the game kind of a month. My screen for some reason is not updating. I think there is some lag in the online software, but nevertheless, I'll just walk you through what I am seeing on my screen. So Nifty closed at 18487. So last 2 days we've had some fall in the index, and after a good run up in the last many weeks, I think some fall is not so out of the syllabus. The good thing is that the small caps and the mid caps continue to run. So mid caps and small caps, mid and small caps are up at a new high in terms of 33,812 on the mid cap index, and the small cap index also touching 10,000 on today's move. Let me just try and get my screen again. Uh, now, for some reason, it is not updating. So yes, we have some one screen that I can show you here. So this is largely the small cap movement in the last 2 3 years, and what you can see here that just like pre-COVID, it was simmering around 5,200 levels, and it continued to stay there for about 6 8 months before the COVID drop came, and then the COVID bounce came, and it again, was squiggling around here in the near the 5,200 mark, and then the breakout happened, and it went 2x from there. Now, similar kind of a pattern is happening here, where it has been, constrained in a small range of 1,000 points, and it has now broken out towards the highs. First, of course, it has to take out the new high at around 10,450, and then it may, this is actually a flagpole kind of a pattern also. It may do wonders in the coming years. So we really don't know how far this current move that has started will stretch, but so far it is looking quite good. Uh, I'll have to keep sharing every slide, I think. Bank Nifty, you can see here, uh, broke out to an all-time high 4 days back. It stayed there for 2 days, and then it has given back up the breakout. So this can be a sort of a detrimental signal where a, a good breakout is not sustaining above the breakout level yet. And Bank Nifty, as you have heard in my previous episodes also, I give a lot of importance to Bank Nifty leading the market on the upside or the downside. So if the Bank Nifty is falling, I mean, it gives me an indication that the market overall is not very strong. Although mid and small cap stocks continue to go up, but Nifty and Bank Nifty are suggesting that they need to consolidate. So there is a sort of a divergence in the market that has come around, and this divergence is going to create some confusion in the market. Uh, so, looking at the sectoral performance of the day, we can see that the real estate and pharma sectors were up almost 1% each. PSU banks also up 0.6%, IT and auto stocks up 0.4%, consumption stocks up 0.3%, but most other sectors, FMCG, metals, energy, infra, commodities, private banking, led by Kotak Bank, all down uh, between 0.1 to 0.7%. If we see the heat map of the day, it is very clear that some large stocks made a move down, and we essentially saw Kotak Bank, which in the last few minutes of the previous session had dramatically gone up on some institutional buying, on some MSCI, weight reaching, but it seems like Kotak Bank and Bharti Airtel both were up in the previous day. In the last 15 minutes, both came down dramatically today, 4% and 2.5%. Coal India also down. The the OFS has been priced at 5 or 6% lower than previous close, so it was down 4.5%. ITC down 1.3%. HDFC Life and SBI Life also down nearly 2%. And the only gainers were really Tata Motors, Bajaj Auto, Divi's Lab, and a few others. Some in IT stocks, TCS was up 1%, but no real sort of, levers was also up 1%, but no real congruent sort of a move across sectors here. So let's move to today's topic of what is how to do sector allocation, how sector allocation is important. Oftentimes we see that most investors remain very confused as to which sectors to choose, which sectors will do well next year or in coming years, how to choose that. It becomes a very perplexing, a complex situation in terms of how to select sector. So, just to give you a brief example from the US market, a very recent phenomena that was seen in terms of how different sectors have played out. Just in the last 2 3 months, you can see that the S&P 500, which is the this dark line here, is pretty much sort of flat or slightly up, up 10% since the beginning of the year. The small cap ETF in the same period is absolutely flat at zero. The AI and robotics ETF is up 31%, going from January 23 till end of May. So 31% versus market at 9.9%. And just see where the regional bank ETF has gone. Regional bank ETF is down minus 30%. So the gap between the best performing segments of the market and the worst performing segments of the market are huge, plus 30% versus minus 30%. And we are only talking about 5 months period. So this is where the major complexity comes: when to switch, how to exit sectors that are not performing, how to enter sectors that are performing. That remains the most difficult part of anybody's selection process. So to give you more insight into how sectors move, we'll just look at some of the sectors over the last few years. So this is the IT sector, and in the last 7 8 years, since 2013, we last 10 years actually so far, you see that it really did well in 2013, somewhat in 14, then it did well in 18, 19 was a washout, 20 and 21 were fantastic years, and the last two have been also sort of nothing sort of a similarly, if I look at let's say auto stocks, then within auto you can see that 2014 autos did really well. Then the next 2 years were kind of just dull. Then 2017 was really good. 18, 19 were down. 20 was kind of even, and then 21 and 22 were good there. Or let's take a look at PSU banks. Uh, PSU banks, if I see the screen here, uh, you can see that it's been extremely choppy on PSU banks. So 2013 was down 33, 14 was up 70, 15 was down 32, 17 was up 26. Then next 3 years were down. Then next 2 years were phenomenal, 41 and 137% and down to 7%. So very, very unpredictable movement of sectors in the long term. And for your portfolio to keep doing well, you will need to churn these sectors. You will need to get out of weak sectors. You will need to get into strong sectors periodically. And that is how you will be able to beat the market. So this is sort of, you know, a given that you will need to do this for a good performance from your portfolio. Now let's also look at uh, how different sectoral shifts are happening on a year wise basis. So let me show you another screen. These are very interesting slides that show you how changes are happening. So you can see this is 2013. You can see 13 IT and pharma did extremely well. Then you had, let's say, 2018. Uh, Let me just, I mean, the screen is troubling me a lot today. I hope the moderator will take care of this. And in 2018, you can see that it has dramatically changed. So many sectors are down, and here bank, FMCG, financial services, and IT is doing well. And then let's take, maybe 2021, uh, and you will see that the picture has changed dramatically here. So just see that. So the way sectors are moving from one year to the other, and within 1 year the way sectors are getting distributed in terms of their gains and losses is very, very unpredictable and very, very tough to get your hands on. So the only way you can do this in our view is to have a very sound strategy, a sound strategy which enables you to you know identify stocks and sectors that are not doing well and you can get out of them. Identify sectors, especially when markets come down and then they start going up from a bottom. Always new sectors will lead the market in new runs. So sometimes you will find that metals are doing well, sometimes you'll find pharma is doing well, sometimes you'll find IT and FMCG is doing well. So you will need to identify how sectoral shifts are happening. And once you identify sectoral shifts, then maybe you can do a approach that, okay, I identified two sectors. Now let me see the market leaders in these two sectors, or the most promising mid caps, or you can just, go in a totally a bottoms up approach and do that. So sectors performing in cycles, and not all sectors perform together in sync. So there's a lot of cyclicality to this. Predictions is very, very difficult affair. You may get it right sometimes, but overall you will see one right and one wrong, one right and two wrongs. Overall, that becomes a very difficult game. And momentum investing basically solves these problems by remaining non-emotional and extremely rule-based selection of stocks and sectors. So here we are not emotionally bound to buy a stock because we have fallen in love with that stock, but because it is performing and it is essentially narrating to us that I am right now ready to be bought or I am ready to be sold. So always look for four things in your strategy: what to buy, when to buy, how much to buy, and when to sell. Buy stocks that are going up, sell stocks that are going down. This is the basic mantra of the markets. If you can practice this in momentum investing or in any other way, there is nothing that will come between you and ultimate profit. So with this, I will end this particular episode. Thank you so much for watching this, and do send us your comments, and let us know how we can improve this content, and do subscribe and like this channel, and we'll see you in the next one. Bye.